Well, so welcome to Harinya Capital Advisors. We have been around for a couple of years now. We founded the business in 2016 and have been through various sort of iterations of change and growth since then. We started off as essentially a Category 1 broker, so essentially just giving advice, traditional stockbroker, if you will. And since then have matured into what we call a Cat 2 FSP, or an asset manager. So we got an asset management license in 2021, and we've been sort of running some managed portfolios since then. Obviously, it's taken some time to build up track record, make sure our team grows, and as the business kind of matures and develops, we've been doing better and better, if you will. So this year we turned 10, which is very exciting. Over the years, we've won a couple of awards, the IntelliDex sort of Securities Broker of the Year awards. We participated in a few times, and in 2024, we actually won the overall top boutique firm and a couple of the other categories. So hopefully, we have some idea of what we're doing. Particularly, these Broker of the Year awards is really focused around the stockbroking offering that we have, rather than the asset management stuff, but the asset management is really sort of becoming our focus now. Just to talk about our stockbroking offering, we are one of very few, one of very few South African brokers that are fully integrated into tradingview.com. So you can trade your account with us on TradingView. We have a number of different offerings, not just the integrated account. We have pure offshore accounts for people who want to trade options and all sorts of futures and equities and CFDs and stuff offshore and want to move money out of South Africa to do so. We also have a low-cost trading offering for high-frequency traders, guys who are very serious about markets and are trading, in and out numerous times a day, very high volume sort of trading. We can do that at very low cost. But the cornerstone of our sort of stockbroking offering is our client community. We do morning calls, we share research. Our traders can talk and interact with each other. We think it adds a lot of value. The feedback we get from our clients is that it adds a lot of value to them as well. And that is something that our clients, tend to enjoy. And we think it's, we work really hard to make sure that we guide our clients effectively so that they can, navigate markets successfully. Our interest is very much aligned with theirs in the sense that the trading that we do is mostly direct market access. In other words, you're not playing against the broker. We're putting your orders through to the actual underlying exchange, and we're sort of just a broker in the middle of that. So our interests are very much aligned with yours, and therefore it's important for us to teach a man to fish, so to speak. So our client community is very supportive in that sense, that we're trying to help our clients and teach our clients, because the longer they are successful, obviously, the better for us as well. So that is kind of the ethos we have over there. The portfolio management side of the business, as I said, we got our FSP Cat 2 license with the certificates on the wall, February 2021. So we've been running some model portfolios, running real portfolios for clients, obviously. Since then, we have various portfolios that we offer. One is a local only rand-denominated JSE-focused local portfolio, and then we have 2 offshore portfolios that we'll be focusing on for today, and then we have we've been essentially running those for a while. I don't want to steal Marco's thunder. I'm going to introduce him to you in a moment. He'll be talking about those. He's our sort of lead portfolio manager at this stage. So thank you very much for joining us, Marco, and for being part of our team. We're very, very grateful for you. What we are also going to be talking about today is some structured products. We started thinking about this a little while ago, and current market conditions obviously has us looking for safety. Our ethos is really that we want to protect capital first, right? We'd rather risk underperforming markets and benchmarks than we want to risk losing our clients' money. We've had a couple of people also ask us for capital guarantee products and for things that give them low risk, good return over a period of time. So we worked with Lucy, and with a long-standing relationship we've had with Velocity for since our business really started, and from a personal perspective, previous firms that I'd worked for as well. So I've personally been working with Velocity for 13 years, and in the capacity of Arenia, we've been working with them for 10. So with Lucy's help, we developed some structured products. She's going to talk about that. And we're really looking to find sort of creative ways in which we can provide low risk, positive return to our clients. If you would like to reach out to us at any point, our office number is on screen, as well as our email address. You're welcome to email us. You're welcome to pop your questions in the chat, and you're welcome to reach out, ask for fact sheets or whatever the case, information sheets on the portfolios that we present. And we can take it from there. So without further ado, I think I'd like to hand over to Marco. So first, a bit of I don't know. Do you guys want to introduce yourselves? How do you want to do this, guys?
No, that's fine. I can do that.
Okay, great. Marco, the floor, sir, is yours.
All right. My name is Marco Olivano. I'm a portfolio manager at Enigma Capital Advisors. I've been a member of the investment committee since 2024. So just looking at my educational background, I am a CFA charter holder and a member of the CFA Institute. And I am focusing at Arenia on the global equities and offshore investing. In today's discussion, we're going to tell you why we think that offshore equities and portfolios are essential for an asset portfolio, where we see opportunities in global markets, and how we position our portfolios and manage risk. So the big question is, why is offshore exposure important in an SA context? So, I would imagine that most of the viewers today are from South Africa. You guys have probably got a lot of your wealth concentrated in South Africa, whether that's through your property portfolios or your businesses. And, often people don't diversify their assets enough. As you know, South Africa is an emerging market. So, we do have a lot of political risk, like all other emerging markets. And the rand does tend to weaken over time. So we do believe that it is quite essential that, a portion of your portfolio at least is offshore in US dollars or other currencies. However, at Arenia, we do all our offshore portfolios in US dollar. So some key points to talk about. If you look at the South African market, especially the top 40, you would notice that about 40% of our index is in resources, and then about 10.5% in NASPAs or process, which is exposed to China. So the problem with this is that, when you're investing in the South African market or in a top 40, a passive fund, or even most managers which kind of benchmark towards the top 40, you do have a very high concentration in resources. And as you would have noticed with, the recent moves in resources, if you look at the gold shares, I was just looking before this presentation, and I mean, some of those gold shares have fallen about 40% from those highs. So if you were just invested in an SA portfolio and you obviously invested at the incorrect time, you could have easily been down about 40% at this point in time, just on the resources, which have obviously impacted the index. So we think that, the SA market is very concentrated, and to try and diversify from that, we do think an offshore portfolio is quite critical in an SA context. Other reasons why we prefer offshore, the South African market is unfortunately quite limited in terms of what kind of sectors you can get exposed to. I mean, we're very highly concentrated, as I said, in resources, industrials, financials. But if you're looking to get to, the growth sectors, which is, artificial intelligence, biotech, and software, unfortunately, there isn't much place to invest in our market. So if you do want to get, exposure to those exciting sectors, unfortunately, the only way to do that is to have an offshore portfolio. Obviously, the other important point to note is the rand's long-term depreciation. So, I mean, the statistics over the last 20 years shows that the rand does depreciate by about 5% per annum, which means that if you invested in an offshore portfolio, you do get the benefit of the rand weakening by being in dollars. So the important point there is diversification plus USD exposure is important, and it does help you to protect and grow your global purchasing power. Moving on to the next slide, we want to talk about the opportunities in global markets. I mean, we've touched a bit about that on the previous slide. Again, access to the different sectors that are not available on the JSE. When you're investing offshore, we do have, exposure to artificial intelligence, biotech, software, all those kind of, interesting sectors that we can't find locally. We also have different access to different geographies. So, for instance, we aren't limited to wherever we want to invest. We want to invest in Europe, in Asia, in other, encouraging emerging markets like Brazil. We are. So we've been invested in Brazil If I'm not mistaken, the ticker there is EZA, and that basically invests in the Brazilian market, in basically a basket of their stocks. And we've done exceptionally well by picking the low points in Brazil. We still invested and we still think there's upside, but that just shows you that by having an offshore exposure, you could literally invest anywhere in the globe, and we're not limited in terms of opportunity as regards to that. Other important reasons, obviously, offshore markets give us broader and deeper market liquidity. So if a lot of you would have tried to maybe invest in small cap stocks on the JSE, and you would notice that they are quite illiquid. When there are market pressures, those stocks fall very rapidly as you battle to find liquidity. Whereas when you're investing offshore, generally the liquidity is so good that, you know, to try and move larger volumes of stock is actually quite easy, and we've got the benefit of that increased liquidity. As I've discussed, greater diversified opportunity set, and our kind of slogan for this is that go where the opportunities are, not very limited. So we like offshore portfolios because we do believe that there is definitely a lot more opportunity in that other sectors of the world. Then looking at our current portfolio positioning, or how we position our portfolios rather, and what our investment approach is. So we use a blend of macro views, technicals, and market sentiment. I mean, we do focus on fundamentally strong companies, and we do identify those companies that are undervalued and that we feel offers a certain good margin of safety. So we are a type of investors that are not chasing market fads. We're not trying to chase the stocks that are running and that are, the technology stocks that are going up 100% a year. We're not chasing them just because everybody else is in there. We prefer to buy companies that we feel are cheap. That gives us a sufficient margin of safety, and that allows us to get good returns without taking too much risk. Moving to the next slide. So, what is our edge? I mean, that's something that people love to ask, why invest in Enigma? And then the other point is, how do we manage risk? So important to note, we are a specialist offshore portfolio, which is, I think, quite rare in South Africa. A lot of the South African managers will allow you to invest offshore, but they will just basically outsource that to another fund manager, which obviously brings up a lot of fees because, you've got middlemen and third parties that are, all trying to take a cut in that. And you're basically being pushed to a manager that's offshore. Not to say that those managers are bad, but unfortunately it does, eat up quite a bit of fees. So just about our team, as I said earlier, I'm part of an investment committee. We are a bunch of market participants that we've known each other for many years. I mean, myself and Pietri know each other for over 15 years. And I think, we've done very well over the years to build up quite a good network of research. We know where to find the best research and who to follow to help us with our ideas. And then we are able to obviously position those portfolios using that research. So as I said, again, we directly invest and we do not outsource any of our portfolios. In terms of risk management, very important, we don't over concentrate. So we try and keep the position sizes quite small, and we don't over concentrate in any sector. So in other words, we're not those kind of managers that are going to put 30% of your money in one certain stock and hope for a home run. We prefer to have smaller allocations, whether that's 1 or 2% or 3%, or if we're really convicted, maybe 4 or 5% in the stock, but we don't over concentrate. In addition to that, to try and protect ourselves from more market drawdowns, obviously, as the Iran situation unfolds and markets do come under pressure, we do feel that it's important to protect that downside risk. And with our portfolios, we are able to divulge into options as well as the big volatility protection. And that helps us to protect our portfolios and minimize those drawdowns for you. So also the last point there, our philosophy, which is to protect capital first and then grow it second. All right, so the next slide, I'm going to talk about our performance. I think this is something that everybody likes to look at, to see how we're doing. So just to make an important distinction here, Enigma has been running offshore portfolios, I believe, since 2021, which means that's about 5 years. And Pietri did inform me before the presentation that those portfolios have had a total cumulative return of 132%. So over 5 years, you would have more than doubled your money. For this presentation's purposes, I am going to focus on the performance of the Enigma multi-strategy offshore portfolio. And that's the portfolio that I started in 2024 when I joined Enigma. So we're going to look at our track record versus the S&P 500, which is denoted by SPY, the SPY ETF, which is, the top 500 stocks in the US. And then we'll look at the iShares MSCI All Country World Index, which is a proxy for a global benchmark. If you look at the performance on the top right at the end since inception, so our portfolios have been incepted since August 2024. Our strategy has given us a return of 40% versus the S&P at 20%. So basically, we've doubled the returns of the S&P 500. We've done that without taking any risk. I mean, we definitely are quite a conservative manager of funds, and we're very proud of the performance that we've been able to achieve at a very, I think, difficult period. I mean, if you think about it, early 2025, we had to deal with tariffs, which caused a lot of havoc in the market, and then most recently with the conflict in Iran. So yeah, I think we've done quite well. I'm very proud of it. If you look at the bottom left on that, the cumulative benchmark comparison, the Enigma performance is in blue, and then we've got the All Country World Index in yellow, as well as the S&P 500 in green. So you would have noticed in the beginning, we kind of stayed on track with the market. And in recent months, we have actually tried, pulled very much away from those benchmarks and really starting to see our performance. And I think that shows you that, as an active manager, where we are watching the market every day, where we are positioning ourselves correctly as conditions change, as we've seen with the Middle East, and the fact that we can use all sort of structures and options and volatility, we are really able to outperform our benchmarks. So the other thing on the slide, I've just put the All Country World Index, which shows you, the exposure to the different geographic regions. And you'll see the ACWI is pretty much mostly America. I mean, it's about 63%. And then you've got Japan and United Kingdom, 5%, etc. So I'm not going to talk too much about that. But yeah, in a nutshell, that's our performance. And if you guys want to see some more about our performance, please do reach out to us. All right, I'm just going to have a sip of water so I don't lose my voice here. Okay, so the next slide is about the currency angle. So look, I don't want to spend too much time on this. I think we've made it quite apparent that when you're investing offshore, you're not only investing in the portfolio, but you're also hedging yourself against the SA-specific risks. I mean, the key stat there is that the rand, on average, depreciates by about 5.1% to the dollar. So the key takeaway from this is that your returns aren't only the asset performance, but you are getting that currency tailwind in your performance. And just on the slide, if you looked at our previous one on performance, these are all US dollar returns. So, over time, the rand does play a role, but for our purposes, we're pretty much focused on the US dollar return. All right, moving on to the key themes. So just to give you some background about the key themes that we have been invested in, and as well as, the themes that we are looking to invest in. At the moment, we've got, more overweight positions, I think, in these sectors. So we're looking at cannabis, chemicals, energy, software, as well as China. So in the next few slides, I'll just give you a little bit more information on those. All right, so cannabis. So yeah, this is a crazy one to start with. Just a disclaimer: none of us are smoking this stuff, so it's all above board, yeah. So please don't be worried about that. Yeah. So why cannabis? So I mean, cannabis is a sector that we've been following quite closely. Since we've incepted these portfolios, we've actually been invested in it. And the major reason why we invested, there's a massive rescheduling of cannabis to a Schedule 3 drug. So what that means is when that rescheduling takes place, and I mean, there has been talk that it should have happened actually February this year. Obviously, there's been a bit of delays. I think with the war in the Middle East, it's pushed a lot of things backwards. But we do think that rescheduling is imminent, and it should hopefully take place in the next couple of months. And the major reason why that is good for the sector is that at the moment, there's a tax rule that these cannabis producers are paying up to 70% tax. And once this rescheduling takes place, that tax rate, I believe, will go down from about 70% to about 21% on average. So there's going to be a massive profitability unlock. It's going to really improve the cash flows of these companies. And the major thing is to also know, because they are a sector which, is not really listed on the main boards on the NASDAQ and the NYC, they're mostly pink slips. So that doesn't allow institutional and mutual funds, the bigger funds, like the likes of your Allen Grays and Coronations in the US, they unfortunately can't invest in the sector. And we do think that once this rescheduling takes place and these stocks are moved to the main boards, it's really going to improve the access to mutual funds. And once that money flows into this sector, we're really going to see a re-rating. I mean, these sectors are let's say this cannabis theme is really the companies are priced for disaster. And, we think they're extremely cheap. And once this regulation takes place and this rescheduling, we should see these stocks really move up nicely. So yes, we are positioned early ahead of those institutional flows, and it's, I think, a sector that will come right eventually. All right, moving on to chemicals. Chemicals, is a sector that we've liked for quite a while. We seem to be coming to the end of the destocking cycle. So you would have seen during the COVID times, a lot of companies stocked up on chemicals, and it's taken a while for them to destock. And we think that we're coming to a point, where people have got to start, picking up those inventories, and we should see demand start to increase in the sector. The other thing is it's, got geopolitical resilience. This conflict in the Middle East is also pushing up those prices, and there's a massive spread between, prices in the US and Europe. I mean, I think a lot of the European producers, and you've seen, I think I read something earlier that it was a 35 million worth of production that's been taken out of the market in Europe, or that have closed, or, factories that have closed. So, we're looking more at chemical companies in the US and out of the European and Middle East that we think can perform quite well. So yes, these companies are at the peak of the debt cycle, and we think that valuations are really, really cheap and are really starting to re-rate. And we like the sector and continue to hold it going forward. Moving to the next sector, energy. I think that has been quite a big topic recently with the price of Brent crude oil, which is, this morning, I think it was at $120 a barrel, if I'm not mistaken. So yeah, I mean, that's been a massive move. So, I mean, from a longer term perspective, I think energy is quite an important thing in the AI driven space. To power these data centers, they're just requiring more and more energy, different types of energy. But I don't think that's going away. The demand in that sector is going to carry on with us for a very long time. The other thing that is important to note is that if you look at energy as a commodity, if you look at the commodity cycle, generally energy is the last one to move, and we've seen a massive move in gold, as well as platinum and silver and all these other commodities. I mean, gold was as high as $5,500. I mean, it has come off, but energy is the last one to move, and we actually started to see that move even prior to the conflict in the Middle East. So, because of this conflict in the Middle East, we've obviously seen energy names move quite aggressively to the upside, and we've used that as a way to trim exposure and take up profit. I mean, we still like the sector, we still want to be involved in the long term, but we do feel that, the runs are a little bit, we ran a bit too much, and it's not a bad time to take profit. And, if we do see a bit of a correction in the sector, we'll be happy to increase our exposure once again. All right, another sector that we're looking at is software. So if those of you that watch the market closely, you would have noticed that a lot of these software stocks got extremely damaged in the last couple of weeks. We saw stocks fall multiples of percent. Like a lot of these software stocks are trading at, I would say, 10 to 15-year lows. And the big thing there is that, there's fears around AI, around artificial intelligence, where, people can build the same software in a weekend, and that will just replace all these software companies. I mean, we don't believe that. I can't see how a Fortune 500 company is just going to give up their payroll or, their software needs to some fly-by-night that's created software overnight. And, we think the move in software stocks is overdone. Another important thing to note is there's a large short base. So the market has become extremely short of this. And in terms of positioning, if we start to see some sort of resolve in the Middle East and markets tracking back up, we think that there's a potential for a massive short squeeze, which should drive the price of these stocks much higher. The last theme, so this one is not really sector related, but more a sector or a different geography that we're looking at. So China is they've got a lot of interesting stocks, especially in technology and artificial intelligence. And we feel that the deflation cycle could likely be coming to an end. We feel that valuations in China are still extremely cheap. I mean, if you look at what you're paying to buy the likes of a Tencent or Alibaba, Baidu, those kind of stocks, we still think it's cheap if you compare it to their peers, global peers. compared to the technology stocks in the US that have had incredible runs over the last couple of years. And we do like China as a theme. It's the place we've been invested in since we've incepted these portfolios. We did take a profit on the recent run, but lately we've seen pressure on those shares in line with the general weakening in global markets. And we are using this opportunity to buy back into China. All right, looking at our current positioning. So given obviously the conflict in the Middle East, we are quite underweight. So moving into today, I think we were only deploying about 50% of our cash net. So, you know, we do change the weightings of our portfolio depending on market conditions. And I think we did quite well to be underweight for the last 2 or 3 weeks with all the conflict in the Middle East. We've seen the markets under an extreme amount of pressure, and that's really helped us to outperform our benchmarks. Obviously, this Iran situation, you know, there's a lot of uncertainty. There's news flows all the time that's driving markets up and down, very, very volatile. I mean, the markets were under extreme pressure this morning, and then just before we got into the presentation, we saw Trump come out to say that, you know, for the next 5 days, they're not going to attack any, you know, of the oil assets or refineries in Iran, and the markets literally shot up 2% from being down 1.5% earlier. So massive volatility, which in a way is good for us. I mean, if we're actively managing these portfolios and we position correctly, it gives us really good opportunities to buy stocks cheap and obviously use these runs to take profits. So just to give you some background on our approach, as we mentioned earlier in the presentation, we do prefer caution over chasing upside. So we are a cautious fund manager. We don't just put your funds into anything. We don't chase the stock just because everybody else loves it. You know, we do our work, we do our due diligence, and we're looking to buy companies that we feel are cheap. We will increase our exposure to the market when clarity improves. So yeah, as this situation in the Middle East resolves and we feel that the markets are at a point where, you know, upside is warranted, we will be very quick to move back into equities. And then just around the protection. So, you know, we do use a lot of options. But options is a product that allows us to take protection on the portfolios and limit our risk. So upfront, we know what we're risking. If the markets do go up, it's not the end of the world because we really know what our defined risk is. And we use a lot of options on indices to protect these portfolios. And then we use the VIX, which is the volatility index. When we believe that volatility is too cheap and we think that there's going to be volatility as we see now, we will buy the VIX and profit from that. All right, I will move on to the structure of our portfolios after I've had a sip again. Okay, so guys, important to note, our portfolios are discretionary managed accounts. So you're not buying into a fund or a pooled fund. They're segregated client accounts. So we make use of an allocation tool. And for instance, if we're buying 2% of a stock, we make sure that every client that's invested in our portfolios gets 2% of that stock. So all portfolios, doesn't matter what size you are, do get treated the same. These portfolios are held with Interactive Brokers, which is our partner and our broker to run these portfolios. I mean, Interactive Brokers has been around since 1955, if I'm not mistaken, or 1975 rather. I know it's about 50 years. And I mean, they've got about 470 billion assets under management. So I mean, look, it's $470 billion that is. So, you know, they're a massive broker, very well known in the industry. I'm sure if you've watched Bloomberg, you would have seen the adverts. You know, it's a really good partner to have. And, you know, it gives us, you know, they've got a lot of security. I mean, you know, it's very secure, a lot of transparency and control. So yeah, we're very happy to have them as a partner. And I must say, if you look at the industry, I've been around for a long time. They're probably one of the cheapest brokers in terms of fees, and we are able then to pass on those cost savings to our clients. So on the next slide, slide 17, we are going to ask the question, who are these portfolios for? So if you are interested in our portfolios, we think that those investors that are seeking offshore diversification, that is for you. So look, if your wealth is very concentrated in South Africa, very concentrated in the rand, and you want to diversify that wealth, you know, we don't think it's a bad idea to bolt on an offshore offering like this. As I've mentioned earlier, you're getting exposure to US dollars. So all our funds are in US dollars. So that means if you want to fund your portfolio rather, you would have to do that in US dollars. As I said to Pietri earlier today, you know, even though we're talking about protection and how important it is to have a defensive portfolio, At the end of the day, this is about long-term capital growth, and we are looking to grow your capital. Our benchmark is the MSCI All Country World Index. So you try and always try and beat that benchmark. And then, as I said earlier, by investing in these portfolios, you're getting protection from SA risk as you are invested in an offshore currency. All right, then to give you some details around our offering. So as I mentioned on that performance slide, we have two different strategies. So Enigma has been running these offshore portfolios for the last 5 years. We call that the Enigma strategy. On that strategy, we have a minimum of $20,000, and there's a good reason why we have a minimum of $20,000. There are minimum fees involved to trade, and we've just found that if the portfolios are smaller than that, those fees eat up performance, and we don't want a situation where clients are invested in something that's not growing. So we have put a minimum of $20,000 on that portfolio. So the Enigma strategy is a diversified global portfolio. It gives you exposure to global equities, where we follow a balanced risk approach, and this portfolio would be suitable for most investors. Then the Enigma strategy, the one that we showed you the performance on, that has been running since 2024. So we've got almost a 2-year track record, which could be quite a small track record in terms of the industry, but we've all got to start somewhere, and we're very proud of what we've achieved there. So with the Enigma strategy, the minimum there is $40,000. Reason being is that we are employing a lot of options in these portfolios, and with options, how it works in the US is if you buy one option contract, the minimum size is 100 shares or 100 shares of an ETF. So your sizes can be quite big, and it's not suitable for a small portfolio. The reason that we use these options is that it gives us an ability to manage portfolio drawdowns and risk more effectively, and also allows us on these accounts to use short selling, which is a little bit harder on the Enigma strategy. Although with the Enigma strategy, we can buy inverse ETFs, which pretty much do the same thing. And then the other important thing is with the Enigma strategy, if we've got a very high conviction, we can use options to play that upside with a defined risk. So it allows us to go a little bigger than we might have done with normal plain vanilla shares, but it allows us to define our risk. So yes, the Enigma strategy also, we think, suitable for a lot of investors that are seeking similar offshore exposure, but with this fund, obviously higher minimums, but the ability to enhance those risk return. So in terms of the fees, so we apply the 220 model, which I think is quite common in the industry. So that means we charge 2% management fee per year. And then we also charge a performance fee, which is 20% above the benchmark. So in other words, if the MSCI All Country World Index has done 10% and we've done 20, so we've outperformed by 10%, we then take 20% of that 10% outperformance, which would be a 2% fee. In terms of liquidity, these are quite liquid. I mean, if you do want to exit your portfolio for, in an emergency or for any other reason, it's not an issue at all. I mean, the US follows a T+1 settlement, which means if you sell today, you should be able to get your money tomorrow. And then obviously there is a bit of a lag between transferring that money to your bank account. And so we think in about 2 or 3 days, you should be able to get your cash back in your account. Just to reiterate, this is a fully discretionary managed account. So you're not investing in a fund, but you are, investing in a discretionary portfolio. So the question then goes, if you are interested, how do you invest in these portfolios? So, very easy. The account setups do take, unfortunately, 1 week. And that is a result of us relying on Interactive Brokers, which is a massive brokerage. I mean, they receive a countless number of applications every day, and we will do our best to get those applications to them. And in about a week, the account should be open. We do have our client relationship consultant, Tracy. She's really hands-on, and she will assist you and make sure that those accounts are open in no time. Also, if you require offshore funding support, so if you want to convert your rands into dollars, as these accounts are dollar-based, Enigma can arrange that at a fraction of the cost that you would pay to convert your rands into dollars at the mainstream bank. So please do inquire about that. Once the accounts are open, they're fully managed thereafter. We take care of your accounts every month. We will send you an update, a monthly update. I do also write a monthly report just to give you a bit of background about what we've done, how our funds have done, what we're seeing in the market. And my clients have really given me very positive feedback. They really like that fund report at the end of the month that just gives them an idea of what we're doing. So we will keep you informed. All right, then just to close, I've taken up quite a bit of time, so I think I need to get done here, but just to close off. So we feel that offshore exposure is essential, especially in a South African context. Global opportunities are expanding, so definitely a lot more opportunity overseas. And we do feel that active management is critical in volatile markets. Again, our focus is on identifying opportunities early, managing risk actively, and delivering consistent return for our clients. Moving to the next slide. So there's just some contact information. If you are looking to have your offshore portfolio managed by us, please do reach out. You can email us there at info@orenia.co.za. You can call us on 010-443-8801, and we'll be more than happy to assist you or answer any questions. Yeah, that wraps up my side of the presentation. I'm going to hand you back to Pietri, but yeah, if you guys have any questions, please do keep those on hand. We will take some questions at the end of this presentation. Thank you very much.
Thank you, Petri. Thank you, Marco, for having me, and thank you for co-hosting with Velocity Trade. As you mentioned, it's been a while the two companies work together, and I hope we will continue working for a while together. I don't know if you can see my screen.
Yes, we can.
Yeah,
it's
great.
Thank you.
So on my side, I represent Velocity Trade. I am the head of investment solutions for the company, and I will present not funds that we manage or fund that Orenia manage, but structured products that is paying a performance indexed on a fund. So the underlying that I'm presenting right now is actually an index that was launched by Solactive. That is an excess return index that is exposed to two different funds that are equally weighted. The first one is a global market fund managed by Jupiter. For those who don't know Jupiter, it's an asset manager founded in 1985 that had around 54 billion pounds as of DEC 25 of asset under management, decent size. The second fund is an European market fund managed by JP Morgan. Both funds that are within this index are actually market neutral funds. What does that mean? That means that they have a low correlation to the stock market overall. The goal is to don't suffer from up and down trends and to just provide a steady positive performance no matter what happens. Which actually brings me to the next point, that they are both absolute return funds. To maybe give a short definition, most traditional funds are relative, which means that if the market goes down 20%, but the fund goes down 15%, the fund manager is considering having done a good job because he actually bet the market or bet the benchmark. When you look at an absolute return fund, it has a different goal, and the goal is to make money regardless if the market is going up or down. So for that, the fund manager will use several strategies and will basically try to generate steady positive return, which much lower volatility than if you invest into the traditional funds or directly in the market. They aim for no correlation at all. If I go too fast, don't hesitate to just ask question. The index also has what we call a volatility target or risk control, RC, which is at 5%. Why do we use this? It's basically a feature that allows to improve the pricing conditions when you're looking at structured products, because when you fix the volatility at a specific level, you remove a parameter to solve for in the equation when you are pricing for options. What is the volatility target? The volatility target is the idea to maintain a maximum level of volatility, in this case at around 5%. Just to give you a comparison, S&P is between 15 and 20% volatility. So here it's very low. And how do we do that? When the market is calm, we invest more into the market. So within the index, there is a leverage mechanism that is up to 150% investing into the market when the volatility is low, which allow you to have more exposure to the market for the same amount of money. And when the market is a bit more volatile and jumpy, we will reduce the market exposure and we will invest into cash or keep it cash to lower the volatility of the index and the strategy. Here you have a lot of information. I don't think it's needed to read it. The index was launched in June 2020. So far, it has a quite good track record in a sense that the index performed by around 64% since inception, which is around 8.59% annualized return. The historical volatility is around 5.5%, so around the target that was fixed. The max drawdown was minus 6.4 for a max duration of 225 days, so almost 1 year to recover. And lastly, the most important, I would say, is the Sharpe ratio. So the Sharpe ratio, for those who don't really know how to read it, is the value for money score of the risk of an investment. So in a simple way, to look at it is when you invest, you have potential return and potential risk. So the Sharpe ratio tells you how much reward you got for how many units of risk you took on. One Sharpe ratio of 1 is considered good. Sharpe ratio of 2 is considered very good or excellent. So here we have a Sharpe ratio of 1.55, which is considered strong to high performance score. It means that in the past, the index produced significantly more return than the risk it took in the past. This brings me to the product that I would like to present. Can you see my new slide? I hope yes. Great, thank you. So it's a product denominated in USD with a mean investment size of 10,000 USD. And we are currently starting the campaign to raise money and to launch the product. The closing date of the campaign is on the 13th of April, so which gives you actually 3 weeks to open the account, make the decision, and invest into this product. The product is a 5-year tenor product, so the horizon of investment is 5 years. You can obviously leave before, but that will be at the mark-to-market price. Otherwise, if you want to keep the position until maturity, it will be 5 years. The exposition is on the index that I just described, and it is paying a 200% participation on the upside of the index. So if the index today strike at 100, then we will look at his level in 5 years. And if in 5 years the index records an upside of 40%, you will get 180%, so 2 times the upside. There is no cap. So if the index flies, your return will fly too. And on the downside, you have a capital protection, which means that no matter what happens, at maturity, you get the investment, you get your capital back. Unless the issuer default, the products are always subject to issuer default. Any question on the product? Actually, I don't see the chat. So if you have questions, I'm sorry, I don't see them. Okay. So let's continue then. So let's say you invest 1,000 USD into this product. That is a 5-year USD participation on the index on the payment date. At maturity, so within 5 years, we will look at the performance. And as it is described here, the return calculation for any percentage of positive performance, you will get 2 times this percentage. And if the index goes down, so below the current level, then you won't get any return. But in any case, you will receive the principal that you initially invested. So there is no risk in the capital. We will forward you after this presentation this fact sheet, so you can just have a look and don't hesitate if you have any question or if you want to have more information. Just to give you an idea of the chart, so this is the performance since inception. This is the current level, the green line. Anything that is above at maturity will be paid ×2. Anything that is below, you won't suffer any loss. You will just get the capital that you invested.